Where is the best area to buy to profit in the next 5 years, considering only cash flow positive unit house with the purchase price of 350,000? So firstly, wouldn't buy a unit. Secondly, I'm not sure how many cash flow positives are actually in the market at the moment, Ramel, and I might just show you something really quickly as well. Well, actually, I didn't even prepare this early, but maybe we'll do that together as well. So I just the, this idea of cash flow positive properties, firstly, to me, are a bit of nonsense. And the reason I say that is, as an investor, you're going to get most of your returns from your, or nearly all of your returns from capital growth, and understanding that you're investing with leverage. That is where you're going to make your money. Cash flow, and I'll show it for you guys here. So I think Ramir's question was a $350,000 property. The reality is most investors are going to be buying a property with a, let's call it an 88.5% loan, but then they get hit with LMI. So they're essentially buying something with a 90% loan. And because of that, because they're getting something with 90%, they end up getting hit with about a 6.7% interest rate. Now, if we come in and we'll put some, I guess, conservative property management fees in here of 7%, if it's a $350,000 property, pretty much guarantee you're not getting any depreciation on that property. And we'll leave our outgoing costs here. So you got your rates, water, insurances, maintenance, all those kind of costs. You can still see here, and even here with a 5.5% yield, it's still costing you $180 per week out of pocket. Now, I don't know what the actual number is. Is it 7%? No, it's not 7%. Is it 7.5? Still not there. Is it 8? So it's probably going to be about what, 8 point, still not there. Okay. So it's an 8.4% yield for you to be able to turn this property profitable. So it's just a bit of a fallacy. Even if you said, okay, the interest rates come back down to 5%, great. You've got a property that's at 8.4% yield, which you won't find those out in the market, but let's just say it was. You've made $5,392 per annum on that, and then you got to pay tax on it. So you made $3,770 odd dollars for the entire year. For me, I would be, I'd be actually happy to lose money on an investment if I knew that with that leverage, I was making tens, if not hundreds of thousands of dollars a year whilst I held that investment. So your cash flow is not going to come during your growth and accumulation stage. The cash flow will likely come for you if you grow your wealth through that capital growth period. Later on, if you're coming in and you've got $1, $2, $3, $4 million behind you, great. Then you can sell down your assets, use that capital, and either one, live off the capital, or two, invest it in something that gets you maybe a 5 to a 7% net return. But yeah, you're not going to be changing your life with these kind of properties. You should be thinking purely on capital growth. If that's if the most important thing is wealth creation, that's where you really need to be. So sorry if that one didn't answer your question the way you were hoping there, Ramu, but I just like to make sure that there is a lot of outdated material, particularly if you get stuck in this trap of seeing other buyers agents or property courses out there and their whole ads. Once you look them up, you look one competitor up, it'll just fill your spam up. It'll be cash flow positive, cash flow positive. If you sit down and you do the numbers, they don't exist. They existed when rates were 2%. But again, that environment is not here anymore, and we're nowhere near that environment. So I would be trying to change my strategy in terms of what I'm actually trying to achieve in the property investment space.